Welcome to this explainer. Today, we're putting on our investor hats to objectively break down the financial fundamentals of Commercial Bank of Ceylon plc. We really want to figure out if its rock-bottom market price makes it a dangerous value trap or an absolute hidden gem. We're going to look past all the market noise and uncover what the raw source data is actually telling us. So let's jump right in.
Here's our roadmap for the breakdown. We're covering the valuation mystery. I'll look at their profitability, financial strength and dividends, the overarching macro risks, and finally, we'll calculate its fair value.
All right, Part 1, the valuation mystery.
Now, here is the million-dollar question. Why on earth is a bank with nearly a 20% return on equity trading so incredibly cheap? Because generally speaking, any bank generating those kinds of returns globally would typically command a massive premium in the market. Yet, as we're about to see, the market is pricing this institution like it's barely scraping by.
Just look at this. The bank currently trades at a PE ratio of just 5.59x. To put that into perspective, most healthy banks globally usually trade somewhere around 8 to 15 times their earnings. A multiple below 6? That literally screams either massive undervaluation or severely elevated risk. It's almost absurdly low, and given the bank's operational health, which we'll get into in a second, this heavily leans toward a major undervaluation scenario.
And then you look at the price-to-book ratio, and the mystery just deepens. The stock trades almost exactly at book value, roughly 1.01x. Quality peers with similar return profiles, they usually trade well above 1.5 times their book value. In fact, according to the source's valuation scoring, this metric earns a highly attractive 9.5 out of 10.
Moving on to Part 2, a profitability powerhouse. These numbers paint the picture of a highly efficient machine. An ROE of 19.51% is absolutely outstanding. Honestly, anything above 15% is generally considered excellent for a bank. Pair that with a return on assets of 1.93%, when most banks are absolutely thrilled to operate between 0.5 and 1.5%, and you've got a management team that is just squeezing incredible profits from shareholder capital. The operating margins sitting between 25 and 30% really just cement that operational efficiency.
And they aren't just resting on their laurels either, they're growing. Despite a pretty challenging economic environment in Sri Lanka, the bank is showing immense organic growth. Revenue is up 13.7%, and assets have grown almost 17%. Now, you might spot that slight negative 3% dip in earnings per share and think, oh, what's going wrong here? But look a little closer. The actual profit increased by a massive 44%. That EPS drop is literally just paper dilution caused by a rights issue. It's the math, not a deterioration of the actual business.
Let's roll into Part 3, financial strength and dividends.
For any bank investor, an absolutely crucial point is capital preservation, right? Well, this bank comfortably exceeds regulatory minimums, with a total capital ratio of 16.70%. But the real standout is their liquidity. A rupee liquidity coverage ratio of 419% basically means they are heavily fortified against bank runs or sudden economic shocks. Combine that kind of cash cushion with a 73.5% impairment coverage ratio, and you're looking at an institution strongly protected against bad loans. It's basically a fortress.
And this illustrates an almost ideal balance for us as investors. You get a really solid 5.23% dividend yield for healthy income generation, but it's paired with a low 29% payout ratio. That ensures the dividend is highly sustainable. It leaves a ton of earnings retained inside the business to fuel all that impressive future growth we just talked about. On top of the raw numbers, their economic moat is formidable. They possess one of Sri Lanka's strongest banking brands, a massive branch network, and a totally dominant position in trade finance. These are competitive advantages that are incredibly tough for rivals to just copy. And perhaps the most telling sign for us? Professional capital completely agrees. A massive institutional ownership of over 66% shows deep-seated trust in this management team to consistently execute.
Okay, Part 4, understanding the macro risks. We have to address the elephant in the room, because the core of this whole valuation mystery is the massive disconnect between their internal strength and their external vulnerability. We have this highly liquid, incredibly profitable institution, but it remains heavily exposed to Sri Lanka's overarching macroeconomic conditions. Sovereign risk, currency fluctuations, and the natural cyclicality of the banking sector during downturns are very real factors keeping a lid on this price.
Because of that sovereign risk, along with potential future EPS dilution if their aggressive growth means they need to raise more capital down the road, the source's analytical risk assessment pulls the overall investment score down to a 7.5 out of 10.
While none of these risks seem immediately terrifying given the bank's fortress balance sheet, they are largely out of management's hands, and rational investors simply have to price them in.
Which brings us to Part 5, calculating fair value. When we walk through these 4 distinct valuation models, it's actually pretty fascinating. Applying a normal 8x multiple for the PE method gives us 287 rupees. The price-to-book and ROE methods both point perfectly to 297 rupees. And an adjusted Graham formula suggests around 330. It's kind of remarkable how closely all these different models converge to suggest an average fair value right around the 300 rupee mark.
When you map this out visually, the opportunity becomes crystal clear. We're looking at the 2025 year-end price used in the analysis of roughly 200 rupees, compared to our estimated base fair value of 300 rupees. That massive gap right there between the current price and the base fair value, that is the investor's true margin of safety.
Doing the exact math, at current levels, the stock appears to be trading at a massive 33.1% discount to its intrinsic fair value. According to the source's assessment scale, finding any price below 220 rupees places this firmly into the very attractive category.
So what's the bottom line here? Bringing together valuation, profitability, growth, and the macro risks, the final weighted assessment from the data gives Commercial Bank of Ceylon an 88% overall score. That firmly categorizes it as a strong buy and a high-quality asset. Literally, the only thing holding it back from crossing into the exceptional 90s is those external Sri Lankan sovereign risks we just went over.
And that really brings us to the core decision for any investor looking at this stock. Is a 33% discount to fair value enough of a margin of safety to offset that overarching macroeconomic risk? That's the ultimate question you have to answer based on your own risk appetite. But as the data clearly shows, you're looking at a highly profitable fortress trading at absolute bargain bin multiples. So is that enough to convince you to jump in, or is the macro environment just too murky? Thanks for joining me on this explainer, and remember to always let the data drive your decisions.